Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're taking a deep dive into SFL's second quarter 2025 earnings call. Now, this one was particularly fascinating because it presented a real puzzle. You got a company hitting its financial targets, yet seeing a significant immediate pullback from the market. How does that happen? We're going to unpack that paradox for you.
Yeah, it's a classic case, really.
Yeah.
You see short-term investor reaction colliding with, well, a longer-term strategic pivot. SFL demonstrated strong operational performance, no doubt. But their messaging and, critically, their actions this quarter signaled a fundamental shift in their business model. And the market is, still trying to digest that. Let's maybe lay out the headlines first.
Absolutely. Good idea. So starting with the raw numbers, SFL reported GAAP EPS of $0.01 for Q2. That's a solid beat, actually. Surprising consensus estimates that were predicting a loss somewhere between making a signs and -3 cents.
Definite beat there.
And revenue also came in strong at $192.6 million, nudging just above expectations and showing a modest year-over-year increase. And adjusted EBITDA, which includes contributions from their associated companies, impressively reached $112 million.
Okay, so on paper, those are really encouraging figures, paints a picture of a company performing well. However, as we hinted, the big news that truly shook things up, that was the adjustment to their quarterly dividend.
Yes, the dividend.
Exactly. They cut it to $0.20 per share. That's down from $0.27 in Q1. Now, it's worth noting, this still marks their 86th consecutive quarterly payout, which is, an incredible track record.
86 quarters is impressive, yeah.
It is. But that 26% dividend reduction, especially when you pair it with some very frank commentary about one of their key assets, well, that appears to be the undeniable primary driver of that immediate, sharp, negative market sentiment we saw. It basically forced a reevaluation by income-focused investors.
Okay, let's unpack that tension then. Strong financials, but the market gives it the cold shoulder. First, on the core operations side, their gross charter hires stood at approximately $194 million for the quarter. Breaking that down, 87% came from the shipping operations, the rest 13% from their energy segment. But what I found truly compelling, looking beyond just the immediate numbers, was the significant strengthening of your fixed-rate backlog. Can you walk us through why that matters so much?
Indeed. The fixed-rate backlog is, well, arguably the crown jewel of SFL's future revenue visibility. Right. It now stands at a really robust $4.2 billion.
$4.2 billion. Wow.
Yeah. And what makes this figure particularly powerful is that a full 2/3 of this backlog, a substantial portion, is with investment-grade counterparties. For listeners, that means the companies on the other side of these contracts have excellent credit ratings.
Right.
Very low risk of default.
Okay, so reliability.
Precisely. This provides SFL with exceptional cash flow visibility and resilience. Makes it more of a defensive asset, especially when the market gets volatile. It's a key indicator of long-term stability in what's often a very cyclical industry.
Right. And here's where SFL isn't just maintaining, they're actively building. They announced 5-year extensions for 3 of their 9,500 TEU container vessels with Maersk, one of the world's largest shipping companies.
Oh, Maersk is huge.
And TEU, for those unfamiliar, that's 20-foot equivalent unit, standard measure for container capacity. This single strategic move with Maersk isn't just about keeping things ticking over. It adds approximately $225 million to the backlog.
Wow.
Yeah, spanning from 2026 all the way out to 2031. But what makes this deal even smarter, I thought, is that these vessels will also undergo significant upgrades, cargo handling, fuel efficiency, and most of those costs are being compensated by Maersk.
That's clever.
So they're securing revenue and future-proofing their assets while shifting the cost burden. Pretty neat.
That Maersk deal perfectly illustrates their forward-looking strategy.
Yeah.
However, looking at the quarter itself, the results were undoubtedly impacted by several one-off operational items. We saw a significantly higher than usual number of vessels in dry dock.
Okay, so out for maintenance.
Right, out of service for maintenance and upgrades. This led to unusually high dry dock expenses, approximately $16.5 million in Q2. Compare that to their normalized average of around, say, $5 million.
Big jump.
It is. Specifically, 8 vessels were undergoing dry dock, and 4 of those were large container ships getting major upgrade projects. While essential for long-term fleet health, it does temporarily reduce the revenue you get from those ships.
$16.5 million. That sounds like a considerable temporary drag on earnings. But the good news from the call is that they expect these costs to taper down significantly.
They do.
Dropping to around $3 to $3.5 million in Q3, and then even further to maybe $1 to $2 million in Q4. So that particular headwind, while impactful this quarter, seems to be easing pretty quickly. That's a positive sign for the next few quarters.
Indeed, that normalization is welcome. But the most significant headwind for SFL, and really the core reason for that dividend adjustment we talked about, it continues to be their Hercules drilling rig.
Ah, the Hercules.
This rig has been warm stacked since Q4 2024. For those unfamiliar, warm stack means it's kept ready for reactivation, but it's currently idle, not earning.
Why idle?
It's due to the broader market uncertainty and, oil price volatility. It's just delayed new employment opportunities for the rig. The critical point here is that keeping it warm stacked costs SFL approximately $60,000 per day.
Per day. Ouch.
Per day in operating expenses. Plus, you've got interest and amortization on its financing. That's a substantial daily cash outflow without an equivalent inflow.
That daily cost really underlines the challenge, and it's important to put that into context, too. While it's idle now, the Hercules rig has significant earnings potential. Huge potential, actually. When it was last fully operational back in Q3 2024, it was a major contributor, generated around $35 million in EBITDA.
Wow, quite a difference.
Yeah, or about $20 million after interest and amortization. In contrast, this quarter, Q2 2025, it only generated a meager $3.3 million in revenues, mostly from contract payments and equipment rental.
Stark difference, yeah.
It is. They also mentioned a lawsuit relating to the rig's redelivery. That's scheduled for the first half of 2026. And SFL has already been awarded a judgment of approximately $45 to $50 million, guaranteed by Seadrill. So that's a future potential cash inflow to keep an eye on, maybe.
That legal judgment is certainly a potential positive down the road.
Yeah.
But the CEO's comments during the call were very, very explicit. The Hercules situation is driving the dividend decision now. The board, he stated, felt it was very prudent to make sure that the distribution isn't effectively subsidized by the company.
Meaning using debt or other cash reserves to pay the dividend while Hercules isn't contributing.
Exactly. Because the Hercules unit is currently out of service and not contributing to cash flow. This candid admission, combined with, reduction in near-term cash flow from recent asset divestments, that was the direct catalyst for the dividend cut. It's a powerful signal. Management is prioritizing financial prudence and long-term investment over maintaining a specific payout level, even if it causes short-term pain for some shareholders.
That really hammers home the strategic pivot, doesn't it?
Mm-hmm.
So putting all these pieces together, the strong backlog, the rig issues, the strategic asset sales, what does this all mean for SSL's fleet and their broader capital strategy? It seems SFL is actively engaged in a pretty significant fleet renewal program.
Very active.
They've disposed of 20 older vessels, average age 18 years. That effectively reduces the overall fleet average age by about 2 years. And this wasn't just random selling, right? It included 5 dry bulk vessels, the redelivery of 8 older Capesize bulkers to Gold Ocean.
Which, importantly, marked their last related party deal, cleaning things up.
Good point. And 7 2002-built container ships to MSC, plus a 2005-built 1700 TEU container vessel.
Yeah, this aggressive fleet renewal isn't just about shedding older ships. It's a profound strategic shift. These divestments have generated over $200 million in proceeds for SFL.
Okay, so cash coming in. Exactly. Specifically, around $20 million from 1 Supermax and 7 container vessels. And a total of about $150 million from delivering 12 of their 15 unencumbered vessels, including those 8 Capesize bulkers. This capital isn't just sitting idle, it's intended to free up investment capacity and improve the fleet's operational efficiency and, crucially, its fuel consumption profile.
Ah, the environmental angle.
Precisely. This aligns perfectly with stricter regulatory demands from the IMO, the EU, pushing for decarbonization. It's a clear strategic play towards modernization, environmental compliance, and future-proofing their business against evolving industry standards. They're positioning themselves to operate a higher quality, more competitive fleet that can command premium charter rates down the line.
Okay, makes sense. And on the financial front, how does all this impact their liquidity position?
Looks pretty strong.
They ended the quarter with about $156 million in cash, plus $49 million in undrawn credit lines. So, including those available credit lines, they now have over $300 million in available liquidity. And that's further strengthened by these ongoing asset sales we just discussed.
Right. They also entered into about $84 million of new financing for 2 car carriers and prepaid about $95 million in debt facilities.
Seems like they're managing the balance sheet actively.
Absolutely. Their liquidity position is robust, gives them significant flexibility. Looking forward, a major part of their capital strategy involves about $850 million in remaining capital expenditures. That's for 5 massive 16,800 TEU newbuild container vessels.
Those are big ships.
Huge. They're expected to be delivered throughout 2028. And critically, they're designed to be funded through a combination of pre- and post-delivery financing arrangements. That minimizes the immediate cash strain. It's a testament to their long-term vision and, their ability to secure financing for these substantial growth projects.
Good point.
And a quick operational note on their existing fleet. Overall shipping fleet utilization in Q2 was strong at 98.1%, or get this, 99.9% when you adjust for unscheduled technical off-hire.
Almost perfect utilization, basically.
Yeah, that high utilization rate really speaks to effective vessel management. And we also had that quick operational update about their car carrier, the SFL Composer, involved in a collision in Denmark on August 4th. Fortunately, no injuries, no pollution occurred. That's always the main thing.
Always the priority.
The vessel went directly into dry dock for repairs, expected to be done by early September, and importantly, no expected impact to earnings due to comprehensive loss of higher insurance. So a minor blip, but well covered.
Okay, so after laying out all these pieces, the strong financial beats, the robust backlog, the strategic fleet renewal, and that persistent Hercules drag, what does this entire picture tell us about how investors are interpreting these results? Why did we see that immediate negative reaction?
That's the core paradox we started with, isn't it? Despite the financial beats on EPS and revenue, the market reacted quite negatively, drove a sharp sell-off. This really suggests that the dividend cut and the ongoing drag from the Hercules rig were overwhelmingly the dominant factors for investors.
They overshadowed the positives.
Completely. Overshadowed all those positives we just discussed, the strengthening backlog, the strategic fleet transformation. It appears that income-focused investors immediately repriced their expectations based on that yield reset. And the near-term cash flow uncertainty tied to Hercules. They voted with their feet, at least initially.
Precisely. And management's strategic storyline clearly centers on pivoting the company's cash flow profile. This involves systematically divesting older, less efficient assets, and then securing those long-term charters with investment-grade counterparties.
Building resilience.
Exactly. The overarching aim here is to significantly increase revenue visibility and build greater resilience against the inherent cycles of the shipping and energy markets. They're trying to transform SFL from, let's say, a purely asset-heavy operator into more of a maritime infrastructure play.
Interesting way to put it. And their continuous focus on fuel efficiency upgrades, alongside that sizable new build pipeline that really underscores their commitment to fleet modernization and improving their long-term unit economics. So for you, the listener, as you track SFL moving forward, key signals will include any news on new employment or strategic action for the Hercules rig. That's a big wild card.
Huge.
You'll also want to watch the execution and financing milestones for those 5 large new builds, any further asset sales, and of course, new charter wins and extensions that continue to build that all-important backlog. Also, maybe jot down the dividend X date, September 12th, and the payment date around September 29th for the new $1.20 dividend, plus any future commentary from management on payout sustainability.
Right. All important watch points.
Okay, let's put on our analyst hats for a moment and think about SFL. The market's immediate gut reaction, I'm going to call it a classic overcorrection.
Possibly.
Yes, the dividend cut stings, and the Hercules rig is undeniably a drag right now. But let's zoom out. We've got a management team actively divesting older, less efficient vessels, bringing in over $200 million in proceeds. Okay. Simultaneously, they're locking in 5-year extensions on 3 massive 9,500 TEU vessels with Maersk, adding another, $225 million to their already robust backlog. That, to me, screams a textbook high-conviction pivot towards a higher-quality, de-risked revenue stream.
You've hit on a crucial point there. This looks less like a simple financial adjustment and more like a profound strategic transformation.
Yeah.
Shifting away from being perceived solely as a yield play.
Exactly. So here's my first pitch for consideration. Let's call it the backlog buffet long. My thesis here is simple. The market is hyper-focused on the near-term cash flow dip from Hercules and the dividend cut. It's completely undervaluing the unique cash flow visibility and resilience of that incredibly strong charter backlog. Remember, 2/3 investment-grade counterparties.
That's the key differentiator.
Right. This isn't just a shipping company anymore. It's evolving into, like you said, a maritime infrastructure play with sticky, high-quality revenues and predictable cash flows. The $850 million CapEx for those 5 huge new builds, funded through pre- and post-delivery financing, signals significant, well-managed future growth. I'm proposing a long position here, riding the wave as the market eventually recognizes the true long-term quality and stability inherent in that $4.2 billion fixed-rate backlog.
Okay, that's a compelling case for a long-term value-oriented play, focusing on that underlying asset quality. But for those with a slightly higher risk appetite, perhaps looking for something a bit more dynamic.
Exactly. For a slightly more aggressive, maybe hedged play, consider this, the Hercules hedge spread. Now, for this, we're talking about taking a long position in SFL, paired with a short position in a pure play, high beta offshore drilling rig company.
Interesting hedge concept.
The logic here is that the market is currently punishing SFL as if the Hercules rig's idleness is either a permanent state or that the entire SFL story hinges solely on it, which it doesn't. While the rig is a drag right now, management remains optimistic about finding new employment or some alternative strategic action. If Hercules does get employment, SFL gets a direct, immediate positive catalyst. Meanwhile, the pure play rig company might simultaneously suffer from broader offshore market dynamics or, increased competition.
So you're betting on SFL's diversification.
Precisely. This is a bet on SFL's diversified portfolio eventually outperforming a more concentrated offshore bet. It mitigates the rig's current negative impact while benefiting from the core strength of their shipping business. It's less a when not if on Hercules employment, and more importantly, a shipping strength call against the backdrop of broader offshore market volatility.
Okay, two interesting angles there. So to recap our deep dive today, SFL delivered strong Q2 financial beats on EPS and revenue. That was underpinned by a robust and growing fixed-rate backlog, largely with those stable investment-grade counterparties.
Sure.
The strategic pivot towards fleet renewal and higher quality assets is abundantly clear. Significant asset sales, bolstering liquidity, substantial new build program underway.
Yeah.
But, as we thoroughly discussed, the market's initial negative reaction primarily stemmed from that announced dividend cut and the ongoing cash flow drag from the idle Hercules rig.
Yeah, highlighting that fascinating divergence between management's clear long-term vision for a modernized, de-risked company and the immediate yield-focused concerns of certain investors. It's a classic short-term versus long-term story playing out. You'll definitely want to keep a close eye out for any developments on Hercules employment and the continued progress of new build financing. Those are critical catalysts.
Absolutely. And remember, everyone, the trade ideas we shared today are purely for informational and illustrative purposes. They are not financial advice.
Definitely not financial advice. Always, always do your own thorough research before making any investment decisions. Thank you for tuning in to the Deep Dive. We appreciate your insights and feedback. Feel free to reach out with your thoughts on SFL's latest earnings or maybe what other companies you'd like us to dive into next. It's a complex maritime world out there, and staying informed is your best compass. We'll catch you on the next Deep Dive.